Before we had the euro, we had something called the exchange rate mechanism, or the ERM. And that was established in 1979. And it kind of laid the groundwork for what would ultimately become the European Economic and Monetary Union. It basically stipulated that exchange rates between certain European member countries would stay pretty pegged relative to one another, while they still had their own currency and their own monetary policy. So their central banks could set their own rates, and they still had their own independent currencies. The premise was that the Italian lira and the Deutsche Mark would have a fixed relationship to one another, but like their interest rates might not be the same. So we'll see why it no longer exists in a second here. Just because two currencies are supposed to be pegged to one another, it doesn't just like magically happen because you say so. You still have open market forces driving supply and demand and driving these things up and down. If they are starting to move outside of the fixed range, you have to have central banks step in and intervene, either through the currency itself or through raising and lowering rates if they don't want to just let their currencies freely float. The UK didn't join until 1990, when they were actually in the beginning stages of a recession. Just in case you're not aware, what had happened right before 1990? We had the Berlin Wall come down. So all of a sudden, you had the reunification of East and West Germany. So you have massive investment all of a sudden into Germany. And what happens when you want to invest in a currency? Well, you have to first acquire money in that currency to invest. So you need to sell out of other currencies, namely the currencies of, I don't know, Europe's second largest economy, the UK, to go buy German Deutsche Marks. The Deutsche Mark starts appreciating very rapidly relative to the currencies of all these other countries, the UK front and center among them. And so the UK has two options. They can either defend their currency so they can stick to this peg and keep it very high, or they can withdraw from the ERM. They chose to try and defend their currency, so we'll talk about how this all played out in a second. Now, amidst this whole backdrop, at the time, a man called George Soros was running a macro hedge fund with his buddy Stan Druckenmiller, who also ran Duquesne Capital. We have a crackerjack 30-year-old analyst at Soros who's covering Europe at the time. I'm going to save his name for the end of this story because I think it's just so perfect how it all comes together. He brings all of this to the attention of George and Stan and all the other senior decision makers. And he's like, this is an unsustainable situation. Okay, you've got a German economy that suddenly looks like it's going to go to the moon versus all these other economies, the UK most notably, that's in a recession that's going to see more outflows. So the guys at Soros are like, hang on, either things are going to stay exactly the same, or the UK is going to have to massively devalue its currency and leave the ERM. The problem with a short position is that something can theoretically go infinitely higher. There's no cap on where something can go. But the stakes of this game where that either something stays exactly the same or drops precipitously. You are supposed to do that trade all day, every day, because the stakes of a short are no longer in play. It's basically unlimited upside. Maybe you lose whatever it cost you to finance the short. They go all in on this trade. They build up a position ultimately of a short of 15 billion sterling. And as this starts to gain momentum, everyone else in the market starts piling on, realizing what's happening. The position was orders of magnitude larger than the size of the fund itself. So the Bank of England sees what's happening and they desperately try to defend their currency. We don't have that many tools as a central bank. So they can raise and lower interest rates, and they actually have reserves in their coffers. And so the first thing they do is they're all part of this joint economic council with the Germans and with everybody else. And they ask the Germans to lower their interest rates. And the Bundesbank is like, no. If you think about it, all else being equal, you want to invest your money in a country that has higher interest rates because you want to get that higher return. So they're trying to encourage people to move out of Germany back into England to help appreciate their currency. Option two, we're going to move our own interest rates. So now, despite being in a recession, on the morning of September 16th, 1992, the UK hikes rates from 10% to 12%. Nothing happens. They panic. That afternoon, they say, we're going to hike rates another 300 basis points. Nothing happens. The UK started the day with 40 billion in currency reserves. So they start desperately going out and trying to buy up their own currency. And they're doing clips of 300 million at a time, 500 million at a time, a billion at a time. But it is like spitting into the ocean. They are up against this $15 billion short that's already there and everybody else in the market who has piled on. They see the writing on the wall and they finally just give up. All right, we're exiting the ERM. Forget about our rate hikes. We're not doing that. The sterling dropped 15% in that one day alone. It is now called Black Wednesday. So 2 fun facts. I learned about this from the NPR podcast. The way that the world found out about this is a month later, there was a dinner in the UK with a bunch of journalists, and the CEO of Fiat Motors said, I made more money in the last month by being a client of George Soros' hedge fund than my company did this entire year. The next morning, the Daily Mail ran a cover story with George Soros' face, and it said, I made $1 billion as the pound crashed. And the second thing is, guess who was the 30-year-old crackerjack analyst covering Europe? Scott Bessent. Yeah. He was the 30-year-old guy who was like, this doesn't seem right.
Yeah.
And so the hedge fund reportedly made $1 billion off the trade. My guess is it was probably more, because you wouldn't just have the currency expression on. You probably had other macro expressions on in equities and fixed income and all these other things. But in the context of what's going on right now in our country, we have a Secretary of the Treasury who knows, I would argue better than anyone else,
100%.
how important it is for a central bank to maintain their credibility. They only have so many tools. You have to guard those tools so preciously and guard your credibility.